With Peter McGuire, CEO of XM Australia. Peter, oil prices down. They've recovered a little bit, but they were down over 1.5% when the New York Times reported yesterday that this deal could be done. I was kind of thinking that we'd drained all the geopolitical risk premium out of the oil markets. How much of it is still left, do you think?
Well, good afternoon, Sean. Greetings from Sydney and hello to everyone. I think there's still a fair few dollars wrapped up in it, and when we think about all of these moving parts in consideration of the geopolitics and, the whole matter certainly has got far more legs to run, then I think that there's probably, $5 to $8 in there, maybe even more. It's been very volatile, as we've seen, and it's been, from a trading perspective, it's been, I think, very attractive. And so is all of the commodity complex, because, you've only got to look at the likes of copper now through 10,000 a metric ton. It's up the best part of 20% in the last couple of months. So, you've got the overall theme, Sean, of industrial demand picking up in China and prices for commodities staying fairly solid at this early in the season. So, I think there's still a fair few dollars wrapped up in it.
A fair few dollars. It certainly feels like they're squeezing it out. Peter, the question on a sort of more macro level, we have the Fed due to meet later this week. Your thoughts on what sort of relevance that is at this point for the commodity markets, and what sort of direction do they point us towards?
Well, I think first off, Sean, you've got US core PCE came out in March, 2.8%. Inflation remains very, very sticky. We understand that there should have been a rate cut pretty much at tomorrow's meeting, if you put your mind back, say, 3 months ago, and that was pushed out from March. Now there's talk that it's going to be, closer to September. You've got an election early November. You've got Larry Summers, emeritus professor at Harvard, saying 20 to 25, if not even 30% probability of a rate hike, not a rate cut. So these are all the impacts. You've got solid push up as far as base metals. They've had an enormous rally to the upside. Grains and across the agricultural sector is fairly hot. And when you're thinking about where you are with the likes of gold and its little brother silver, they've had big sell-offs, about $100, but nothing too tremendous considering
I've a lot of profit taken, you'd think. I mean, my gosh.
Oh, Sean, it's been an outstanding trade. I mean, it's been showtime since the early part of October. 1,800 to 2,400, where do you find blowouts like that? $600 move, 35% in the, it's nearly as good as NVIDIA.
It's scary what it's communicating, though. I mean, and you think gold moving like an NVIDIA stock, like a growth stock, there's a cuckoo in the coal mine somewhere. Just don't know what the coal mine is.
Well, I think it's going to be, when do you see rate cuts? What happens as far as commodity consumption? And I think the overall picture is going to be relatively strong, I think, for demand for the likes of crude, and for price. I believe it'll edge up higher from here. Everyone's saying that copper's got the capacity to be the best part of nearly 12,000 by the end of the year, currently at 10,000, and only a couple of months ago was, nudging 8,200, 8,300. So, there's a strong appetite out there, Sean, and copper's a wonderful barometer for world economic health. So I think at the moment, if things escalate geopolitically, I think oil prices will certainly surge from here. And I'm keeping a very close eye on US dollar index, because I can't see that the US dollar is going to actually tail off anytime soon. I think the first one to cut will be probably Eurozone, considering how they're looking. It's anemic at best. And that's the lay of the land over the next couple of months.
Peter, we've talked about where the Fed may go, obviously meeting tomorrow, and general expectation, keep everything as it is. Europe, however, has the ECB seen enough to give it a green light to cut and diverge from the US?
I think that's very much in their mind's eye, Sean. How long that timeline until they actually press the go button, there's no doubt that they need a cut. And when you look at as far as consumer sentiment over the last couple of years, it's quite not only anemic, it's pathetic. And then you've got the overall picture as far as Germany, manufacturing, what's going on across France and Spain. So the whole zone is pretty much underwater. And you had a flat, remember that the fourth quarter was 0 GDP. You've had an uptick at 0.2 for the first quarter of this year. So yes, while that's a little bit of green, I suppose, green shoots, Sean, I think it really does need a shot in the arm, and a rate cut is very much on the radar, and possibly you might see that by summer.
Even with a little bit of inflation still on the table, they got to swallow it to get the economic engines moving.
Absolutely. I mean, it gets to a point, Sean, as you know, it gets to stagflationary, because you've got the inflation ticking higher and you've got very anemic growth. And if it needs some help. And I think that rate cut would certainly help things. I think that'd take a little bit of pressure off the euro as well. And trade king dollar.
Peter, one of the reasons it seems that oil prices have come off a little bit, at least the momentum that we saw them move above 90 a barrel in earlier in April, the investors from sort of fund managers, hedge funds, and so forth, sold at the fastest rate for more than 6 months. Once the sort of Israeli-Iran face-off seemed to sort of fade away, and the appetite for that volatility had gone. Your thoughts on what role the hedge funds and investment funds, the paper money, if you like, are playing in this market and will play? If they don't have appetite, very difficult to see oil prices going above $90.
Well, a couple of things. Exactly right, Sean. And I just want to say another side. We spoke briefly about China. China's up for the part of the CSI 300, has had a bounce since the start of February, up 16%. So don't discount China. It's on a tear, and you've only got to be at 20%. You've got a raging bull market. So that's in less than 3 months. Now, I think what's happened, the smart money, Sean, they saw that situation with, I think it was evaporated. It was too hot, and that hot air blew off. And people said, right, that there's no more upside as far as crude. The smart money jumped into gold and they ramped it up, and it rode like a stallion on a beach, just absolutely flat strap. And it went to 24.40. It was a solid push up, and then the smart money, naturally, that evaporated out. And I think they've just been trades over the last couple of weeks. Smart money has found opportunity, and I think the smart money has now gone into copper in the last couple of sessions, and that's probably where you're seeing activity. So it's been a dynamic month to trade commodities, first oil, then to gold and silver, and then to copper.
And what about, Peter, just to finish off, yen at over 160? I mean, I don't even know where to begin to analyze that. What is that? I mean, it's been a slow progress, not that slow, but ultimately we broke out of that classic historical 1 to 110 range on the dollar. Now we're up above, breaking through 160. I mean, and the Japanese economy seems to be taking it in its stride. Where are we going with this?
Well, yeah, I mean, Sean, I think it certainly bounced, and everyone's saying it was probably interventions to some extent yesterday. It hit 160 a bit above, and now it's at 156.70. So, yeah, there's been no word of it, but I'm sure that something's happened to really get that big leg down. And there's probably going to be, again, wild gyrations in the yen. When you're at this sort of level, and this is what all traders have got to be mindful of, you can get swept out very, very quickly trading, with leverage. So I think that we're waiting to see what happens as far as Japan. Put your mind back to 85, and I can, as far as the Paris Accord, and it was at 242. So it's still, I'm not surprised to see the yen probably tail off. You've got to be conscious. Nikkei 225 on fire, went up. It's about 38,000 now. It's cheap for the Japanese. You've got an aging population, and you've got the other side of it, a raging stock market.
Thank you so much, Peter McGuire in Australia. Thank you very much, Noor Aslan Ahmed in Singapore.